Hi, I'm David Cross. I own U.S. Asset Management, and thank you for joining me for this brief primer on investing with inflation. The headlines about economic collapse are everywhere, and I think a lot of it is scare tactics. But just in case it's not, we've developed some strategies and some thoughts to help you deal with it should it ever happen. When it comes to investing, you have 5 basic choices: stocks, bonds, cash, real estate and real assets, and precious metals like silver and gold. Let's take a look at the returns on different assets in the last 5 years. For cash, obviously, if you started with a $100,000 investment, you got whatever interest that you were paid, but at the end of the 5-year period, your cash was still worth $100,000. If you invested in stocks over the last 5 years, the price appreciation has been 61%. That's excellent. If you invested in bonds, however, the price appreciation has been negative. You're down about 10%. You did get some interest, but your bonds are worth 10% less than they were 5 years ago. Gold has actually done quite well. It's up about 54% in the last 5 years. Excluding dividends, the returns on real estate investment trusts that are traded publicly is about 8%. And silver is also up about as much as gold. It's up about 54%. When I lay these charts on top of each other, they allow you to compare them all simultaneously. And as you can see, stocks, gold, and silver have vastly outperformed cash, bonds, and real estate investment trust. While the investments on the previous slide occurred the way that they did and we had superior returns from precious metals and from stocks, we also need to understand what pushes some of those returns. We're going to take a look at the money supply and the national debt because they are key influencers of what's happening with asset prices. Let's take a look at the United States national debt going back to 1965. At that point, we had about $1 billion. $1 billion, that's it. I wish we had that today. Instead, we have $32 trillion in national debt. Let's take a look at the money supply in the United States of America. Something called M3 tells us how much money exists in the world. And don't let the Federal Reserve's numbers and how they calculate things confuse you. It's really very simple. M1 is the dollar bills you have in your pocket. M2 is the dollar bills you have in your pocket plus what you have in your checking account and savings account as an individual. And M3 is the money in your pocket plus what you have in checking accounts and savings accounts plus what corporations have in their checking accounts as well too. So as you can see, the M3 money supply has grown exponentially over time. Now we're going to lay the national debt on top of the money supply and look at how well they're correlated. The blue line is the national debt, and that's at $32 trillion. That's the scale on the left. On the right-hand side, we have the money supply at $21 trillion. That's the scale on the right. And as you can see, they both follow each other very closely, and there's a very good reason for that. The chart you're looking at now is the U.S. stock market as measured by the Standard & Poor's 500. It's the 500 largest companies in America. This data goes back 10 years and it shows you a graphic representation of the price change that has happened with the price of stocks over the last 10 years. And as you can see, it is moving up over time in the last 10 years. Now I show you what the national debt looked like going back to 1965. Here's what it looks like in the last 10 years. It's nearly doubled from about $17 trillion to over $32 trillion today. Here's the last 10 years of our money supply. And as you can tell, it is nearly doubled also, very closely resembling the national debt chart that I just showed you a moment ago. So now when I overlay the stock market chart with the money supply chart in the last 10 years, you can see that they're very closely correlated. The reason being is that if more money is floating around in the economy and people who are investors accumulate more of that money, they will be accumulating more financial assets in the form of stocks. Stocks have proven to be a very good way to hopefully hedge yourself against countries printing too much money, which is what I think we have happening right now. This is a chart of United States inflation going back to 1947. We're going to cover why this is really important, but as you can see, inflation has gone from nearly non-existent, and this is a log chart, where things have gone up in price from 1947 to right now by a factor of over 10x. And this is just a chart of inflation going back in the last 10 years in the United States. And as you can see, we moved from around 235 on the index up to over 300. So inflation is up about 31% in the last 10 years. It doesn't feel like it's gone up dramatically, except for like the last couple of years. But in the last 10 years, it's kind of like boiling a frog. If you do it slow enough, the government is hoping that you just don't feel it. Here's an easy way to explain inflation and a way to protect yourself from inflation as a consumer. So what you're looking at is a candy store in about 1957. In 1957, you can ask parents, grandparents that lived at that time, if your grandfather gave you a quarter, what could you buy with it? And frequently what you'll hear is that you could have bought 2 or 3 candy bars, maybe a pack of baseball cards and a little bit of bubble gum, but 25 cents would have gone a long way to buy a lot of candy as a kid in 1957. If you give a kid today 25 cents and tell them to go down to the grocery store or to the gas station and get whatever you want, 25 cents doesn't go anywhere at all. It might buy a gumball from a gumball machine, but it won't even buy a pack of gum today. Here's where we're going to drive home how to protect yourself and how to protect your buying power. If today you gave a kid a 25-cent piece from 1957 and that kid was smart enough to say, hey, this quarter doesn't feel like all the others, and discovered that it was actually made out of silver, a kid could actually go sell that silver quarter today, and with silver at $22.60 per ounce today, that single quarter is worth $4.08, which, believe it or not, is actually enough to buy a couple of candy bars and maybe a little something extra. What I just showed you with the United States printing so much money in the last several years and the stock market going up over time is really going to be driven home with what I'm going to show you with what happened in Venezuela in the last 12 months from the fourth quarter of 2022 until the fourth quarter of 2023 right now, about a year's time. What we saw is that their stock market is up a stunning 400%. And you would think that it's up 400% because things are fantastic in Venezuela, which they really aren't. Wink, wink. All right, so let's take a look at the next chart. So I just showed you on the previous slide that the Venezuela stock market was up 400%, which sounds awesome, until you recognize the fact that if you took your currency a year ago in Venezuela, let's say you had $100 in Venezuela, and this is what it might have looked like at that time, and you put it into your sock drawer, $100, and then you pull it out a year later, that $100 is only going to buy about 25 cents on the dollar of what it bought a year before. That is tremendous destruction of value, and it's coming because the government is printing so much money. A year ago, if you had one single dollar and you decided to buy bolivars, you would have bought about 819,000 bolivars for every single dollar right now. Today, 1 year later, $1 buys almost 3.5 million bolivars. That's a change of 428%. Here's another lesson we have to take from how to protect your money. If a year ago you had an ounce of gold in Venezuela, it would have bought 1.35 billion bolivars. Today, that 1 ounce of gold will buy 6.5 billion bolivars, or about 400% more, which is strangely in line with about what I showed you on the stocks a couple moments ago. I'm a big believer in learning from the past. One of the most fantastic books I've read in my career is Tomorrow's Gold by Mark Faber, or Dr. Mark Faber. It's not about investing in gold. It's about finding the gold from your ideas and looking at the way that financial assets are priced in different types of environments. I just showed you that in Venezuela, if you held onto your cash, it lost most of its buying power. If you bought a government bond that came due a year later, it was about the same as cash. Yes, you might have gotten some interest on it, but you still have a maturity value that's about 73% less than what it was a year before. If you bought stock, you maintained your buying power because stocks are up about 400% down there. If you bought gold, you also maintained your buying power up. It was also up about 400%. If you bought real estate, depending upon what you bought, you probably helped maintain your buying power, but the problem is it's not liquid and not everybody's walking around with trillions of bolivars. So what I've shown you so far are just some of the basic lessons that we take away from the real world of economics and understanding what happens. And I do think that we are on a similar path as Venezuela, although I don't think that things are going to crash right away. The United States has got the reserve currency of the world right now. And for that, even though we're on the same path, it's going to take a long time for what happened in Venezuela to make its way through the United States. But here's a dashboard that we use on a daily basis where we try to figure out what's happening with the markets right now. And it is about the middle of October 2023 right now, and we can see that stocks have been surging after the most recent report. That market pulse on the left-hand side, that changes every single day. The CNN Fear and Greed Index. Yes, I know CNN. We all hate CNN. But they've actually got a really pretty well built tool that's on there that tells you kind of like what the temperature of the market is right now. And as of this date right now, or last week, the fear index was actually pretty high. So we want to be buying when fear is high and selling when greed is very high. So we use this as a tool to help us gauge when we're going to be moving into investments and out. And then the last one on the far right hand side is the money flow index. The orange line shows you how much money is going into bonds. The blue line shows you that money has been coming out of stocks. And then, in the last or so far year to date, there is money that is net positive going into stocks, but it's certainly a lot less than what we're seeing going into bonds right now. But we use these as tools to help us build the framework to understand what's happening in the market right now. So who do we help? There's a misunderstanding out there that we only work with like high net worth people. And the reality is that's just not true. When I worked at other firms, I was always told that if we had accounts that were like less than $500,000 or so, the firm wouldn't pay me. I thought that was just terrible. I want to work with people who will follow our advice. But the typical folks who we work with are 50 to 70 years old. They want help with future planning. They want help with the what if scenarios. They're trying to figure out if I buy this or if I buy this piece of property down here, or if I sell my business at a certain time, how's that going to impact me? Can I retire? What's retirement going to look like? There's a lot of different math that goes into trying to figuring these things out. Some of the folks we work with have difficulty making investment decisions because, let's face it, there's way too much data that's out there. Also, the people that we work with, they don't want to be judged. We've got folks that will call us up sometimes and say, hey, I want to have a certain percent of my money in gold and silver. And when we say we're okay with that, one of the responses we frequently get is, wow, you didn't make fun of me or laugh at me like my other advisor. And I think that's terrible that happens. But the key thing is that we want to help you solve the problems that are most important to you and help you get there comfortably. If you're not comfortable with our advice and with how we explain things, then you're not going to be able to stay on the ride so that we can get to your destination. This is our very important disclaimer slide, which I have to tell you, we didn't give you any specific investment advice. We won't do that until we know about you and your situation. Please feel free to reach out to us. Our job is to help you make better decisions with your money. I'm available all the time. You're not going to be a number over here where you're one of 1,000 clients that we have to keep up with. We'll know everything about what's going on in your life and what's important to you. Thank you for watching. If we can help you, reach out to me at david.cross@us-am.com. Call me at 678-894-0697. I'll call you back immediately, or visit our website at www.us-am.com. Again, that's www.us like United States -am like asset management.com. Thanks again for watching.